Hi, guys. Wanted to take a couple minutes here to talk through investment strategy and hopefully give you a picture into how your account is invested and why we invest the way that we invest. As a general rule of thumb, I want every family I work with to have an understanding not just how they're invested, but why they're invested in that particular manner. And so you'll see the screen in front of me here. We're going to talk through a few different items. But first, we're going to start off 30,000 foot view. When you think about investing and you think about building a portfolio, you have three basic building blocks that you can choose when you construct your investment portfolio. Those three blocks are stocks, bonds, and cash. Now, there's a stark difference between them. And so, as you can imagine, and as you may know, stocks, historically, potential for 10% per year, significant growth potential. When you think about bonds, we're talking about a lot less than that. Historically, 5 to 6% has been reasonable. However, interest rates are much, much lower. That's fantastic if you're buying a home. It's fun to see an interest rate when you purchase a home of 3%, 4%. However, when you're investing in bonds in a low interest rate environment, we're now to a point where 2 to 3% is more likely from a bond perspective. Thinking about cash, even less, 1 to 2%. Now with an inverted yield curve, what we're seeing is cash can have the ability to earn similar yields to bonds. So the big question to ask then is, when you're approaching your investment portfolio, how do you make decisions? What is the right way to make decisions on allocating between stocks, bonds, and cash? Real estate's in there as well, but we'll come back to that. So thinking about where to allocate your portfolio, your time frame should be the number one dictator of how you invest. And so let's pretend that in your situation, you're not going to touch this money for 10, 20 years. If you have a 20-year time horizon, and we pretend that this is a 20-year graph, well, stock market history tells us that even if there's a huge crash at the beginning, probably not a big deal. Over 20 years, we're going to see significant growth. Does that mean that it's always going to be perfect? No. We're going to see ebbs and flows. There are going to be significant recessions, market crashes over the course of 20 years. But we do have solid reason to believe that with a 20-year time horizon, stocks should see very, very encouraging growth during that time. Now, let's roll back the clock. Pretend that we don't have a 20-year time horizon. Let's pretend that we're saving with the intent that we're going to be spending this money 2 years down the road. Well, if our time horizon is now 2 years, we legitimately have no idea what's going to happen in the stock market. No one has any idea what's going to happen in any given year, despite how many forecasts and predictions you see. And so historically, what we find is that if you're going to use and spend the money you're investing in less than 5 years, there really is a speculative, almost a gambling element to your investing. And so less than 5 years, we want to be weary of our stock allocation. If we know that we're not going to spend this money in the next 5 years, if it is more of a 10, 20-year time horizon, then we can have significant allocation towards stocks. History gives us a pretty solid benchmark in that 5 to 10-year range. Just pinpointing on the 5-year range. Throughout history, if you look at portfolios and how they've performed in rolling 5-year periods, almost 95% of them have been positive. And so what that means is, if we're taking, let's go 1919 to 1924, and then we're going 1920 to 1925, 21 to 26, all the way to the present day, the vast, vast majority of those 5-year windows, if you invested in stocks and stayed invested, were positive. And so note, during the last 100 years, we've seen significant crashes. And so keeping your funds in place, staying invested for a 5-year period, at many intervals throughout the last century, that meant that you saw a significant crash. Yet, had you stayed invested, the vast majority of the time, you came out just fine. So that gives us a benchmark. If our time frame is less than 5 years, we want to be cognizant. We want to be cautious as we approach stock investing. time frame longer than 5 years, we want to take on more stock exposure. What we're really trying to do when we approach this, we're trying to balance and weigh two different risks. And so market risk is the apparent risk that most people are terrified of. That's the idea that your portfolio could lose significant value in the short term. And so in any 1 year, you could lose 20, 30, 40% or more. That's possible, and it's happened. And it's not fun to think about $1 million turning into $500,000. Now, the second risk is a little more muted, and it's not talked about as often, but it's significantly worse. And that is, I call it running out of money risk. You could call it inflation risk, but the idea that your money over the course of time is going to be worth less. And a lot of times we don't think about this, or we know that inflation is real theoretically, but we don't think about the practical implications and just how it will impact our lives. Really quick example, the price of a stamp. We don't send a whole lot of letters these days, but the price of a stamp, say it's around 50 cents. Just one generation ago, in the early 1990s, stamps were about 17, 18 cents. And so just in the previous 25, 30 years, we've seen the price of just about everything be about 2.5 times more expensive than it was. That's going to continue to happen. And so if you think about inflation being around 3%, and what if bonds only make 3%, but inflation's at 3%? Well, all of a sudden, we just lost all the return on bonds. And so big thought here is we want to have a really strong foundation. We want to have a strong reason as to why we're allocating the way that we are between stocks, bonds, and cash. And given a long time frame, that moves us in the direction of having a good reason to have solid stock market exposure. Now that we know that, now that we're understanding that we're going to have stock exposure, the question becomes, what's the best way to do that? There are thousands and thousands of different public companies that you can purchase stock in today. There are 10,000 mutual funds available for you to invest in. There's an enormous amount of money managers. And so the question becomes, I know that I need stock. What's the right way to invest in stock? This next slide is just a picture that really lays out the different ways to analyze different stocks. And so there's different measures that you can use to delineate the difference between one stock from another. On the left-hand side here, we see size. A great example here, think about a small company, think about Whataburger, for instance. Whataburger is not everywhere. They are just really in the southeast part of the states. They are not international. Compare Whataburger as a small company to McDonald's. So if you have a choice, if you could invest in either one of those companies, there's some give and take there. On one hand, McDonald's is a pretty safe investment. McDonald's is everywhere. They're gonna wake up tomorrow morning all over the world, and they're gonna create value. They've already expanded everywhere. There's a little bit of safety there. On the other hand, Whataburger hasn't. So technically, there's a little bit more risk involved with Whataburger. There's also a little bit more opportunity. Theoretically, if Whataburger wanted to, they could go into every state, they could go international, and we'll see if that's something they do. But that gives you a picture, the difference between a small and large company. Historically, this has been one of the dimensions that has shown greater returns. And so what I mean by that is, historically, small companies have returned greater yields than large companies. And so we've seen bigger returns in small companies than large. That's pretty logical, though. It's pretty reasonable. You're taking on a little bit more risk with a small company. This top section here, we see a delineation between value companies and growth. Now, value growth, think growth company like Amazon, Uber, Netflix, Tesla, companies that they're not necessarily trying to pay you a dividend. They're focused on appreciating, they're seeing their price appreciate over time. Value companies like Walmart, Coca-Cola, they do typically pay a dividend. And Coca-Cola is an excellent example. For like 50 years, Coca-Cola has increased their dividend. So there's a long track record there. Now, interestingly enough, this is another dimension that over time, historically, value companies have outperformed growth companies. Now, you might hear that and think, well, what about this last decade? And that's a great example where we do not want to pinpoint any particular part of this chart. And so even though historically value companies have been really tremendous and they've outperformed, well, growth's been pretty awesome over this last decade. You think about Facebook, Amazon, Netflix, Google. These are companies, especially the technology sector, where it has taken off and it has been the impetus for significant S&P 500 growth. So that leads us. There's one other dimension that we talk about, and that's profitability. Typically, high profitability, companies that have high profitability return greater amounts than companies that are not as profitable. But one thing we want to touch on with this graph is we're not looking at this picture. We're not looking at these boxes trying to pick one. That's not what we're doing. We're looking at these boxes, and it might dictate how we allocate things. If we want to take on a little bit more risk and have a little bit more exposure in small companies or in value companies, we can do that. But what we want to do is we want to maintain exposure everywhere. We want to not pick out any single portion. There's a temptation, and it's pretty strong, to take a look at the most recent 5 or 10 years. And so you look at a list of mutual funds and you see what did these mutual funds return over the past 5 or 10 years. The problem with that, if you look right now, it's probably going to be large growth. It's going to look great, for example. But does that mean that large growth for the next 10 years is going to outperform just like it did in the previous 10? History tells us not necessarily. History tells us, especially, think about U.S. compared to international stock. For the past 10 years, U.S. has done significantly better than international. So there's a strong pull to remove all of your investments internationally and put them back in S&P 500, in U.S. domestic funds or U.S. stocks. That's something that we don't want to do. We want to maintain global exposure. Reason for that, the past 10 years have been so good for the U.S., it's incredibly likely that the next 10 years could be a huge opportunity for international markets, emerging markets, to do much better. In fact, since 1970, and I love this picture that we have here on the screen. It's showing there's 9 different ways to break down companies, and you could say you could do this for U.S. and international, but we could simplify it. You could simply say that there's 3 types of companies. So every public stock in the universe could be categorized as one of these 3. U.S. large cap, U.S. small cap, and international. If you make those delineation, if you put all public companies into those 3, and you look back since 1970, whichever one of those 3 has had the best decade, it has always followed up having the worst decade in the next 10 years. And so, great example of that, 1990 was an incredible time for the U.S. stock market. And so U.S. large caps just had a fantastic decade in 1990. But in 2000 to 2010, well, that decade was not nearly as good. In that decade, U.S. large caps did 1% per year. Small caps did better, international stocks did better. And so, main point here being, whatever returns you see over the past 5 or 10 years, that is not an indication that you need to move all of your assets into those areas. In fact, it probably means that area could be a little bit overvalued. And it's possible, and history would say it's likely, that if something has a poor 5 or 10 year stretch, it's probably valued pretty attractively and could rebound really well. And so we don't want to pick any particular one. We want to maintain coverage everywhere. Lastly, you see this playing out pretty vividly in this picture. This is just a picture of the last 20 years of investment returns. And you see all the different colors. Those colors are representing different parts of the market. And so you can see here, for instance, in 1999, non-U.S. equity, those are international stocks that are developed. So think Europe, Japan, companies that are domiciled in those nations, in those areas. Small cap equity, that's U.S. companies that are smaller. Large cap equity, U.S. large cap, think S&P 500. And then we also have real estate, cash, and then we have bonds here as well. But the picture that you see here is one where it's not, investing is not a practice where you simply pick one area of the market and you're not going to know whether that one area is going to outperform the others. The biggest takeaway when you look at a picture like this should be the randomness of returns. That we do not know, no one knows which one of these areas of the market is going to outperform all the others. Great example, look at emerging markets here in the orange. And so those are international companies that are more emerging markets. Think Brazil, Russia, India, China. 2003 to 2007, just unbelievable growth, an incredible stretch there. Then in 2008, it loses 53%. And it had some really good years here. And then in the last 5 years, it's really been pretty poor. Really since 2011, with an exception being in 17, it had a great year. And so this is just another picture to say, we don't want to try to guess. We're not going to be in the business of timing the market. We're not going to be in the business of guessing which parts of the market are going to take off. We want to make sure we own all of it. And that's one reason why we use dimensional funds. Dimensional funds are a fantastic way to get market exposure everywhere while maintaining a focus in the dimensions, in the elements of the market that historically have provided higher returns. And so we want to get away from stock picking and have a more academic approach. And we'll do some more videos on this. But one of the big reasons why we use dimensional funds is their commitment to evidence-based investing and academic investing. The company was actually founded by multiple Nobel Prize-winning economists. And so when we invest, we don't want to do it, picking rabbits out of a hat. We're not guessing. We're not timing. We want solid foundational reasons for why we invest the way we invest. Hope this is helpful, and we'll talk to you guys soon.